This session in the Vanguard Passive Roadshow is focused on looking at the case for indexing. My name's Glyn Jones from Vanguard Asset Management. We've got a number of things that we'd like to run through with you today. First is a brief look at Vanguard and who Vanguard are and what our credentials are for talking to you today. The second part is to really pick up on the UK case for indexing and why passive fund investing actually works, what the data suggests. What we found when we talk to advisors and look at picking winning funds, it's extremely difficult to do so on a consistent and regular basis, particularly before the funds do the numbers. What we'll also be looking at the end of the session is why all passive fund managers are not the same. And I know that Peter Sleep from 7IM will pick up on this in his session and looking at what makes those passive fund managers different. But if we kick off for a moment, a brief look at Vanguard. Who are Vanguard? Well, Vanguard was formed back in 1975, and any of you that have read the books of John Bogle will know that John set up Vanguard back in 75. Vanguard really introduced the first passive mutual funds to the US market. Bogle's background was managing the Wellington Fund, and when he left that fund to set up Vanguard, he really wanted to bring passive fund investing to the retail investor in the US. Now, since 1975, Vanguard has grown into a very diversified business. Diversified not only to the people that we deliver investments to, the institutional market, the advisor market, and direct to customer, but also the different asset classes that we manage. This slide really just shows how big that business has become. We now manage in the States around $1.8 trillion. And a lot of that is based in passive funds, but also in the US we do manage a number of active funds. Actually, nearly half our assets are in active funds. A lot of that is based in fixed income, but the consistent thing across all those funds is that we're doing it at particularly low cost. So on those passive funds, we're looking at TERs of our UK funds of about 0.15 for our UK equity fund. Vanguard's share of ETFs and mutual funds in the States now runs to over 40% of the market share. So we feel that we've got the credentials to contribute to today's session. As I mentioned when we set the scene for today's session, the other contributors are looking at the ETF delivery of passive investing. Vanguard is really looking at the simplest format, the mutual fund. But one of the elements that we really want to contribute today is trying to look at the case for indexing itself. Why does passive fund investing work? So what we're going to spend a little bit of time on now is looking at something called the zero-sum game, why indexing works, and also within that looking at the importance of cost. And that's something that we really need to bear in mind throughout this session. Now, I really like Warren Buffett. A lot of you will have heard of Warren Buffett as being one of the greatest investors that we have around today. And one of his comments is that the markets are a very efficient mechanism for transferring wealth from the active to the passive. This is another quote from Buffett. Actually, in the Berkshire Hathaway annual report, he refers to the fact that the easiest way of capturing the returns from the market and the returns from stocks is to invest in a low-cost passive fund. And what we've seen over recent years, both in the US and in the UK, is that a move to passive fund and indexing has grown. What we're seeing in the UK, we're seeing a lot more new entrants to the market, a lot more diversification and range of propositions being brought to the market. We've got contributors today from Deutsche and iShares looking at the way that their ETF propositions have developed, and also asset management groups like 7IM starting to bring out propositions and investment propositions that use passive fund investing. And that's both in the retail space and in the institutional space. Now, the theory behind why indexing works, one of the things that we often talk about is the zero-sum game. And the next slide really looks at that zero-sum game. What you need to do when you look at this graph is imagine that the returns from a market are portrayed by this curve. And what we've got here is a typical bell-shaped distribution curve where a lot of people perform towards the middle of the market. Very few people perform at the bottom end of the market. Very few people do really well. And the majority of the people are in the middle. So if you look at this chart, on the right-hand side, you've got the winners that beat the market average, and on the left-hand side, you've got the losers that perform less than the market average. And what you have in a typical market is that those winners and losers actually cancel each other out. Now, one thing that Charlie Ellis refers to, if you read some of the books by Charlie Ellis, he actually refers to the zero-sum game being more of a loser's game. And what he means by this is that as soon as you then take cost into account, the number of winners in the marketplace actually falls to quite a small number. Now, Lipper referred to the average TER of a UK equity fund being around 1.66%. So if you start to put those costs into the zero-sum game, it becomes that loser's game that Charlie Ellis refers to. So the important thing here is once you take costs into account, it becomes even harder, particularly over time, 5 years, 10 years, 15 years, it becomes harder to consistently beat the market return. And the sorts of numbers that we see do play out over those time periods where 60% underperform, 70% underperform, 80% of funds in a market will underperform the market average. So we're not saying that active management doesn't work, but it's very, very difficult to consistently keep picking the fund that's going to outperform. Now, for those of you that were down at the IFP conference back in October, you may have heard Charlie Ellis talk, and three things come out when Charlie speaks. One is that he's got a wealth of experience. He's been an investor for over 50 years, and he talks about how the market has changed over that 50 years. The first thing that he refers to is the number of trades that are taking place on a daily basis and how that's grown from the millions to the billions on a daily basis. He also talks about that when he first started off in the market, the majority of investors were private individuals, retail investors. So 90% of the business was being done by the retail investor, 10% was being done by the institutions. And as he says now, over the last 30, 40 years, that's completely turned around, so that 90% of investment is being done by institutions. And we've also seen in recent years the growth in derivatives. Obviously, 30, 40 years ago, derivatives didn't exist. Now they do. And all those things coming into play really feed into this idea of the zero-sum game becoming a loser's game, because the retail investor is up against the institutions all the time. Now, since we first did these passive roadshows with 7IM back in October 2010, we've actually brought to the UK market a new UK case for indexing. So using UK data to prove or to illustrate why passive fund investing works. And here are just a couple of charts that show that over periods of time, 5 years, 10 years, 15 years, it doesn't matter whether you're investing in small, medium, or large cap stocks, the difficulty is outperformance. And we have a chart here that also looks at fixed income. So we've looked at UK equity, we've looked at fixed income. One of the things that these two graphs also illustrate is something which we refer to as survivorship bias. Now, the way that I like to understand or explain survivorship bias is if my son participates in a cross-country race at school and he starts off and there are 100 runners in the race, he actually comes 50th in the race. But when he crosses the line, he's actually the last person to finish. So in terms of the race results, he's last. But actually, 50 people dropped out of the race, never made it to the line. So is he last or is he 50th out of 100? And one of the things that we have to look at when we look at the performance of funds in particular is the effect of survivorship bias. Because what happens when funds underperform is that asset management groups merge them or close them. And that can have a profound effect on the data. Now, this is some interesting research that Vanguard did with Morningstar. You'll actually find this research in a white paper that we produced called The Advisor as Alpha. This research looked at the first 5 years of performance in the UK market from January 2000 through to December 2004. And it actually ranked UK equity funds in terms of performance and split them into 5 categories. So it divided the returns that they'd seen in those 5 years and said that we would have a top quintile all the way through to the bottom 20% of funds. And what's interesting then is to look at what happened to those funds and their performance in the subsequent 5 years. So what you'll see in the first column is that 22% of funds were still ranked in the top performing sector in the following 5 years. But interestingly, if you take that top line across to column 5, you'll actually see that 21% of those funds, the funds that had performed well between January 2000 and December 2004, actually ended up in the bottom 20% of funds in the subsequent 5 years. So you had just as much chance in picking a fund that was going to stay at the top as you had in one that was going to end up in the bottom. Equally, if you look at the funds that were in the bottom category in the first time period, then 20% of those funds that were in the bottom category actually turned out to be in the top category in the following 5 years. And all this data is suggesting is that it's very, very difficult to pick funds that are going to consistently outperform. If you look at the column on the far right-hand side, the missing funds also refers back to the idea of survivorship bias that I mentioned earlier. So in that top sector, top ranking of funds, we're actually seeing 8% of funds disappear in the subsequent 5 years or be merged. And in the bottom sector, we're seeing 17.9% of funds disappear. So net, where do we get to? If we look at UK funds, how well have we been served by those funds? This is some research that again appears in the Advisor as Alpha, the Vanguard white paper called Advisor as Alpha. And really what it's saying is that net, we haven't been served well by the equity and fixed income funds that we've seen in the marketplace. Looking at the data and putting together a portfolio of those funds, we've actually seen that what we've got in effect is a higher volatility and a lower return from the average equity and fixed income fund, which is totally counterintuitive to what we're trying to achieve. What we'd like to achieve is a higher return and less volatility. So net, this data suggests that we're not being served well by the funds that we're buying.